When is the best time to do a Roth conversion? We all know that money in a Roth IRA grows completely tax-free forever. But that does not mean that Roth conversions are right for everybody. In today's video, I'm going to walk you through when you should, as well as when you shouldn't, consider a Roth conversion. Hey everybody, I'm James Canal with Root Financial Partners, and I'm here to teach you what you need to know to create a secure retirement. So there are some tremendous benefits to owning a Roth IRA. However, Roth conversions can be costly if you don't do them at the right time. In fact, they can cost you more in taxes than they actually save you. So in today's video, we're going to walk through what are the times in your life where you should and should not consider a Roth conversion. But before doing so, let's go over some of the benefits to a Roth IRA. Number one, the biggest benefit of a Roth IRA is it will grow completely tax-free forever. It's no secret there that that's a benefit. That's going to help to save a tremendous amount on taxes over time. Now, another benefit of Roth IRAs is they do not have required minimum distributions. With a traditional IRA, you have to start taking out money from those accounts at specific ages. With a Roth IRA, that's not the case. Also, Roth IRAs impact things like IRMA surcharges, which are your Medicare surcharges. Because income that comes from Roth IRAs isn't taxable, it helps to keep your Medicare surcharges under certain thresholds. So it's very clear that there's some strong benefits to having a Roth IRA. A lot of people will ask me, will say, James, we understand all these benefits. Should we start to do Roth conversions now? And in some cases, the answer is yes. In some cases, the answer is no. Roth conversions can be a great tool to decrease your future tax bill, but it all depends upon your individual situation, whether it's the right thing for you today or not. So when should you consider Roth conversions? Number one, in years where your taxable income is low. This doesn't necessarily mean your income, but your taxable income. For a lot of people, this is in the first few years of retirement. Let's assume that you're working, and when you're working, you have a high-paying job, and that high-paying job puts you into a higher tax bracket. Well, if you're doing Roth conversions then, you may end up paying taxes on that money at a high rate, and you may have actually been at a lower rate in retirement, even when your required distributions are kicking in. So if that's the case, it doesn't make a whole lot of sense to do a Roth conversion because you'd end up paying taxes at a higher rate than you otherwise would have had that money stayed in a traditional IRA. Now, let's assume the alternative. Let's assume you just retired, and let's assume that you have some cash that you're living on, and you don't have a pension, you don't have Social Security that's kicked in yet, it's just cash you're living on. Well, even if you're living on 80, 100, 150,000 per year, whatever the amount is, that cash has already been taxed. Meaning, even though your income is allowing you to do everything you want to do, your taxable income is much lower. So in years where your taxable income is much lower, those are years where it makes sense to consider converting your Roth IRA, and not necessarily doing the entire amount, but converting enough from your traditional IRA to your Roth IRA to fill up specific tax brackets. Do you fill up the 10% bracket, or the 12% bracket, or the 22% bracket? That question largely is determined by what will your future tax liability be, and when required minimum distributions do begin, when you do have full Social Security, when you do have your full income coming in, where are you projected to be at that point? And the answer to that should really determine how much do you convert today. But the bottom line is when your taxable income is lower, those are oftentimes some good years to consider doing a Roth conversion. When you shouldn't consider doing it is probably those years where your income is much higher. Now, when your income is low isn't the only time that you should consider doing Roth conversions. There are other moments where it makes sense. One of them is when markets are down. Now, this one's a little bit harder to predict because you don't know how far a market will fall, you don't know when it will recover, unlike income, where you can somewhat predict what your taxable income will be in certain years. But let's look at an example. Let's assume that you have $500,000 in a traditional IRA, and you've already determined that it makes sense to convert that whole amount to a Roth. Let's just use a very simple example here. If you're invested in, just say, an S&P 500 index fund, and you wish to convert that over the next 10 years, let's assume that you want to convert $50,000 per year. Well, if you're going to do that, what that means is you would want to convert 10% of the account balance each year, before, of course, we factor in any growth, but you would want to convert $50,000 per year from your traditional IRA to your Roth IRA. So let's look at that. In year one, you have 10% in your Roth IRA and 90% in your traditional IRA. So we took 500,000 balance, moved 50,000 to the Roth, kept 450,000 in the traditional IRA. Great. 90% is pre-tax, 10% is after tax. Well, let's assume that same example, but what if the market had dropped 50%? Well, if your IRA went from $500,000 to $250,000 and you still converted $50,000 of it, that now represents a conversion of 20% of your IRA balance as opposed to 10% of your IRA balance. What that means for you is when the market recovers, now what you have is 20% of that growth happening completely tax-free and only 80% of that growth happening in a pre-tax account. So as you can see, if the market's falling, especially if you know that a Roth conversion is part of your strategy, those are some years where it could make sense to convert, because when the growth recovers, when the recovery happens, it's going to be happening in a completely tax-free account as opposed to happening in a pre-tax account. Another year where it may make sense to do Roth conversions is in a year where you have significant tax deductions. Usually for people where this makes a lot of sense, especially if they have a good plan in place and a good tax strategy, is if there's something like a donor-advised fund that they're funding. If they have a charitable gifting strategy where they might make one significant gift to a donor-advised fund to get a really significant tax deduction. Well, if you're taking that tax deduction and it's driving your income very low, that might be a great year to increase your taxable income by implementing a Roth conversion. Now you'll want to do this strategically so that the income created from the Roth conversion is at least partially offset by the significant deductions that you're taking. But if there's a year where you have significant deductions because of charitable contributions or medical expenses or whatever it might be, if you have itemized deductions that are really driving your taxable income lower, and not just lower, but fairly significantly lower, what that's doing is it's putting you back into a position where your overall taxable income is much lower than it would have been. If you remember from our first point, the time to do Roth conversions is when your taxable income is lower than it's otherwise going to be in the future. So sometimes in years where there's significant deductions that you can take, those are years where you want to expedite or accelerate some of the Roth conversions that you're going to do. Now I mentioned I would talk about when you shouldn't do Roth conversions. I've touched upon that a little bit with each of these examples. But I would not do a Roth conversion if you didn't have a comprehensive plan in place that helped you to understand what your taxable income is today, what it's going to be when you're retired, what it's going to be in future years when required minimum distributions kick in. If you don't have a general sense of the landscape that you're going to be working within, it's hard to know if a Roth conversion makes sense for you or not. It's really not until you can understand what will that look like for you today versus the first few years of retirement versus the future. That's where you can start to understand, is a Roth conversion going to be helpful or is it going to actually hurt what I'm looking to do? Another time to look at this of when it probably doesn't make sense is I'm in California. Decent amount of clients of mine are in California, and they'll ask, does it make sense to do a Roth conversion? And for some of them, yes. And some of them, I say, well, let's look at your financial plan. You told me that when you retire, you're going to go to Texas or you're going to go to Florida. Do we really want to do a Roth conversion in a year where you're not just paying federal taxes, but also a lot more state taxes? When you move to those states, there is no state income tax. So why would we do that in a year where we're going to have higher taxable income because of the state that we live in? Should we consider doing it in another year like that? But the point of it is you should have a plan in place. Part of your comprehensive financial plan should be that tax analysis. What will that look like at varying points along the way? So when you're asking the question of a Roth conversion, it's not a black or white cut and dry answer. It's really, does this enhance or does this detract from the financial strategy that I already have in place? Generally speaking, if your income is much higher, it doesn't make sense to do it. If you are in a state today that you won't be in retirement, and the state you're in today has a higher tax bracket, sometimes it doesn't make sense to do it. So in conclusion, a Roth IRA can be an absolutely incredible tool to help you reduce your tax liability throughout retirement. Roth conversions can be an incredibly effective way to get money into Roth IRAs from pre-tax balances. But to determine if it's right for you, to determine if you could potentially save tens if not hundreds of thousands of dollars implementing an effective Roth conversion strategy, you should really relate it back to your financial plan. Identify those years where your taxable income is lower. Identify those times at which your portfolio balance is down because the stock market is down. If you can do that, you could potentially be in an incredible place to use Roth conversions effectively to minimize your lifetime tax liability. Now, I mentioned one of the most effective ways to implement a Roth conversion is to combine it in a year where you have significant deductions. If you'd like to see how you could implement a charitable giving strategy that leads to significant deductions, be sure to check out this video above. Thanks for watching. This is James Knoll with Root Financial Partners. If you enjoyed this video, please be sure to share it with someone else who you think would benefit from this information. And also, please be sure to like and subscribe for more content just like this. Finally, if you'd like to see how we help clients create a secure retirement, be sure to check out our website at rootfinancialpartners.com.